Manus Costello, the CFO of Standard Chartered, joins me now on set. So Manus, welcome to the show and congratulations on a first set of results with you in this new role.
Thank you, Ritika.
So first of all, let's discuss the results. You beat consensus despite what has been a tough macro backdrop. So talk to me about the drivers behind this, the biggest surprises that you had in the quarter and how that is setting you up for the quarters ahead.
Thanks. Yeah, look, we're really pleased with what was a record first half performance for the bank. Our income was up 6% in the first half, and that was driven by our very powerful franchises in wealth, which was up 38%, and in global banking, as you mentioned, which was up 19% for the first half of the year. They've really put us in a very strong position on the journey toward delivering against the financial commitments that we made at our investor event in May, a couple of months ago, where we laid out our longer term targets, and we're really thrilled with the start we've made on that journey.
So when it comes to the wealth income, that again, as you mentioned, was a standout performer. What are you seeing in terms of inflows from your clients across the regions, particularly in Asia? I mean, are you still seeing some caution there?
Well, look, we've got a very strong wealth business. We're the third largest wealth manager across Asia, and we've got a very broad-based business both by geography and by product. And what we've seen in the first half of this year, as in fact we've seen for some time, is really good growth across a range of products, across our range of mutual funds, across our range of structured products, across a range of all the kind of products that we offer, and by geography. So we have good growth across all of our key centres, and we're really pleased with how we've delivered in the first half of this year, and we're really confident going into that second half as well.
Global banking was also a strong performer. What is that being driven by in particular?
We have a global banking business which has been repositioning and has been putting itself in a position to continue to take market share over the last couple of years. What we've done is deepen our franchises across different areas of the business. We've got very powerful franchises in areas like infrastructure. We've got very powerful franchises in areas like DCM across our footprint. We've seen good activity from customers. We've seen a really strong first half of the year, and we're really pleased with that performance.
But you booked a sizable impairment, and that was down to the Middle East conflict and geopolitical uncertainty. How much of that is being driven by the Middle East and what we're seeing in the war there, and how is that directly or is that through second order effects?
So in the second quarter, we booked an extra $44 million of impairment or cautionary provision, I would say, for the Middle East. We booked a little more in the first quarter. That takes us up to around $230 million of precautionary impairment that we've taken for that. What I would say there is that the underlying asset quality that we're seeing in that region remains robust. We provided disclosure at the first quarter, and we've given a bit more today about the shape of our business in the Middle East. We're very comfortable with how those businesses are performing, but given the macro outlook, we thought it was prudent to take a little more in terms of that top up. But the main charge that we took for that was in the first quarter. It was a smaller top up in the second quarter.
So you announced the $1 billion share buyback. I mean, did you feel that was the right time to deliver on that, given, and time to return capital when you do still have this uncertainty around the Middle East?
Well, we reported a very strong CET1 ratio for the quarter of 14.2%, so we believe we're in a very strong position in terms of our capital, and we're also generating a lot of capital as well. And when we spoke to investors in May, we made a commitment about how we would deploy that capital in terms of growing the business, and we're very happy to continue to put that capital in to ensure that we're growing the business, paying a dividend, and any surplus we will consider what to do with it, and we decided at this point that the right thing to do was to return $1 billion by share buyback. So we think it's absolutely the right thing to do given the strength of the balance sheet and the strength of the capital generation that we're seeing.
And China is a key market for you. I mean, how would you characterise the confidence compared to 6 months ago, and what are you seeing in terms of corporate demand there?
Yeah, look, I was in Shanghai recently with our management team, and it was really interesting talking to the team on the ground about the shape of our business and the shape of the Chinese economy and what they're seeing. We're very focused on our China business as a franchise, by which I mean we do the domestic business, but a larger piece is the international business that we do with China. So we have about 2/3 of our income related to the China franchise comes from outside China, from corporates who are doing business outside China. And we're doing really well there. We're seeing strong growth in the channels of China exporting and China going out to the world. So there was a real positive sense when I spoke to colleagues in Shanghai a few weeks ago.
And let's focus on the UK now, because we have a new Prime Minister and a new Chancellor. Have you met with the new Chancellor? And does this new change of political leadership, does that change your outlook for the UK economy or for banking more broadly? Are you concerned come the autumn budget if we get higher, further taxes on the banking sector?
I've not yet met with the new Chancellor, no, but we've had constructive engagement with the UK authorities, with the government, with our regulators over a long period of time, and we expect that will continue. We have a two-way dialogue with them, really. We talk to them about our regulation and about our outlook in the UK, but of course, as an international bank based in the UK, we can also bring a lot of information to the authorities about what we're seeing globally as well. So we have a great two-way dialogue, and I hope that will continue under the new administration.
And also the bank has been very vocal when it comes to AI and the productivity gains that could be gained from this. So what kind of tangible benefits should investors be expecting from this within the next, say, 12 to 24 months?
I think the investment in AI and the benefits from AI will play out over a long period of time. They're baked into the kind of guidance that we gave previously. I think it will give us both the capacity to grow revenues very fast, and we've given a good range of revenue growth out to 2028, and we've upgraded our income guidance for 2026 as well. So it does help power top line growth as we give productivity tools to people in the front line, particularly in areas like wealth management, to enable them to service clients better. We also think it will enable us to get better operating leverage. So we think we can grow our revenues faster than our costs over the next few years. AI is one element of that. There's lots of other factors that go into that, but it really will be a game that plays out over a longer period of time.
And of course, capital markets has been driving a lot of gains. It's been quite resilient this year. I mean, are you seeing a healthy pipeline when it comes to IPOs, bond issuance or M&A this autumn?
Yeah, I mean, part of what drove that strong performance at 19% from global banking in the first half was strong DCM activity. We don't have an equity business, so we don't have an equity pipeline, but we have seen good activity in the fixed income issuance space, and we continue to see a good pipeline into the second half of this year. And that's part of what gives us the confidence to upgrade our guidance this morning on income.
And then quick one to end, what is your biggest risk that could throw off some of the guidance?
There's always risks in the world. I'm a CFO. I'm paid to think about risks. The macro situation remains volatile, as we see overnight. There are all sorts of different things that could happen. But for me, the important thing is that we've got a really solid foundation. We've showed the good momentum in the first half of the year, and I'm really entering the second half with good confidence.
All right, we'll have to leave it there. Thank you so much, Manus Costello, the CFO of Standard Chartered.